Let's assume you just got a $5,000 bonus from your work. And you were thinking of making a one-time payment to your mortgage. Well, first of all, congratulations. It's always great to have some extra money at your disposal. Now, before you decide whether to make that one-time payment, let's talk about a few things that you need to consider. First of all, let's think about your mortgage and the impact that extra payment could make.
Let's assume you have a mortgage balance of $500,000 at 5% interest rate. You are making a biweekly payment of $1,360 every other Wednesday. Out of that payment, $398 goes towards your principal. And 71% of the payment, that is $962, goes towards paying the interest. It is important to understand how your interest amount will change over time. Your interest is calculated based on your current mortgage amount. For example, in this case, your yearly interest is calculated as 5% of $500,000, which comes to $25,000. You are paying bi-weekly. That means you are making 26 payments in a year. So, let's divide the yearly interest into 26 parts. This comes down to $962.53 of interest. This is the cost of borrowing the money. The remaining $398 of your payment goes towards actually paying your loan. Let's see what your next payment looks like. Since you pay $398 towards your principal, you owe the bank $499,602. When you make your next regular payment of $1,360, $399 would go towards the principal and $961 will go towards your interest. This time, an extra dollar goes towards the principal compared to your last payment. Although that may look insignificant, every extra dollar you pay back at this point of the mortgage means you won't pay interest on that for the remaining lifetime of the mortgage. If you continue paying your mortgage at this rate, it will take you 24 years and 6 months to pay it off. And by then, you would pay $369,014 in interest. Now, let's see what happens when you make an extra payment of $5,000. First of all, when you make an extra payment in addition to your regular payment, all that money will go towards your principal. This is because you would have paid the interest with your regular payment. This is the biggest perk of making one-time payment to your mortgage. So, when you pay the extra $5,000, the principal of your loan decreases by $5,398, resulting in $494,602 being used as your principal for next payment. Your next regular payment of $1,360 will be split into $409 towards your principal and $951 will go towards interest. You are now paying $11 extra towards your principal compared to your last payment. If you continue making the regular payments from this point, you will pay off your mortgage in 24 years and 1 month, and you will pay a total of $357,167 in interest. Let's compare how the extra payment impacted your mortgage. With the extra payment, you will pay off your mortgage in 24 years 1 month and pay $357,167 in interest. You will be mortgage-free 5 months earlier. And, the biggest perk, you'll save $11,847 in interest. Since you are in very early state of your mortgage, you would save significant dollars in interest for every extra dollar of principal you pay. This amount could vary, however, based on different factors. For example, the amount you save would be higher if you were paying more than 5% in interest. It also depends on the number of years you have to pay your mortgage off. By paying some extra amount now, you are not paying interest on that amount for the rest of your mortgage term.
Who doesn't like to save the interest payment? Right? But it may not always be a wise idea to use the money to make the extra payment on your mortgage.
It is important to consider your priorities when you decide how you'd want to use the extra money you have. Ultimately, you want to put the money somewhere that gives you the best value in return. First of all, let's think about other debts you have. Do you have a credit card debt that you have been paying interest for? It's generally a good idea to prioritize paying off your credit card debt before your mortgage. This is because credit card debt typically has a much higher interest rate than a mortgage, so you could end up paying much more in the long run if you don't pay off your credit card debt first. For example, let's compare the option of paying the $5,000 towards your mortgage that is at 5% interest rate and your credit card that charges 19% interest. The payment towards your mortgage saves you $21 in a month. However, the same amount paid towards your credit card debt saves you $79 in the month. There is clearly more bang for your buck in paying off the high-interest loans you have.
Another option to consider is to put the money into a savings account.
Yes, that's correct. Put that money into a high-interest savings account and forget about it.
Consider this as your rainy day or emergency fund.
The value of a rainy day fund lies in its ability to provide financial security and peace of mind.
By having money set aside in a rainy day fund, you can avoid having to turn to high-interest credit cards or loans to pay for unexpected expenses, which can save you a significant amount of money in the long run.
It can also help you avoid financial stress and anxiety in the face of unexpected events, such as losing your job or facing a medical emergency.
Biggest perk?
It lets you sleep well at night.
You should also do some research on the policies of your lender. Do they allow you to make extra payment on your mortgage? Most banks allow you to make limited extra payment on the mortgage. However, the policy on when and how much extra payment you can make without paying penalty differs from one financial institution to next. It's always a good idea to check with your bank to understand their specific policies on making extra payments on your mortgage. Also, let's talk about investing the money. When thinking about the value for the extra money you have at hand, don't forget about investing the money somewhere you can generate profit from it.
It is generally better to invest the money if you are confident that you can generate higher profit from it than the interest you would pay for your mortgage.
Are the stock market performing very well? Are you a business owner and are looking to expand your business? Since mortgage is a secured loan, it is generally lower in interest than other business loans. So, if you have a business idea and are willing to take risk, you may want to invest the amount instead of paying towards your mortgage.
There might not be a single right answer on whether you should make extra payment towards your mortgage. If you have a set amount and no other high-interest loans, you can split the amount and pay a part of it towards the mortgage while setting aside some for emergency fund. There is definitely a lot of value in paying towards your mortgage. It will help you pay less on interest and build equity in your home more quickly.
So, consider all your options and analyze which one has the most return for the money. Also, consider your peace of mind and what makes you happy. Thanks for watching this video.
If you want to learn more about personal finance and get tips on how to manage your money, make sure to hit the subscribe button. We upload new videos regularly, so don't forget to turn on notifications to stay up to date. Thanks for your support, and we'll see you in the next one.